Roundtable. I'm Tom Nunemaker with Jim Riggio and our guest, Bill Visconto. Before we get started, we have our disclaimer. It's at the bottom of all our website pages. The Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial. Please be aware of all of your risks prior to placing trades. Trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commission. With that out of the way, Jim, you know Bill a lot better than I do, so why don't I give you the ball and why don't you tell everybody a little bit about Bill.
Thank you very much. Yeah, Bill, I guess I've known you now for about, it's been more than 3 years, I think, at this, so just about 3 years. Bill is a founder, one of the two founding partners of EAB Investment Group. And what EAB does is that they are a institutional registered investment advisory firm. Their clients, they don't have any retail clients. Their clients are not even through the investment advisors you would go to. They're the fund managers. Their clients are things like pension plan managers, hedge fund managers, big institutional money managers. And what they end up doing, what EAB does for these institutional money managers is that they end up helping them build their strategies with hedges. What they're trying to do is take out the volatility, take out the downside sting, while still allowing them to keep as much of the upside as possible. When they end up doing that, they really end up helping performance numbers. Hey, Tom, do you see my screen or do you see a lake?
I do see a lake and your screen, so hopefully the same thing.
I see.
Okay, hang on.
Yeah.
Okay. So, I was driving down to Annecy in France one year, Tom. Anyway, what they end up doing is they end up helping clients or helping institutional managers to be able to lower their volatility, lower their risk, which ends up increasing all of those technical numbers that professional money managers end up using when they're allocating. They're looking at beta and Sharpe ratios and Sortinos. The disclosure, for EAB that we end up getting is pretty much the same thing, except for EAB is a registered investment advisor, but they still don't know your situation, and they still not recommending any trades to you. This is basically the overview of what Bill and his partners do. They do I've seen them do evaluation of strategies. They'll take a look at correlations, very, very quantitative and based. They have a PhD quant on staff. And Bill is one of the 3 lead partners, and he is the director of derivatives trading. Bill, why don't you give us a little bit about your background?
Okay. First of all, I want to thank you for inviting me to the roundtable, Jim and Tom. So to give a little bit of background on me, I started in the business close to 18 years ago as a floor trader in New York. Most of my career was spent with a company called PFTC Trading. We started with 3 guys, $1 million of capital, and we organically grew that capital to $160 million in as little as 7 years. We were a very quant vol shop, very heavy quant. You know, we had 4 PhDs on our staff at that time, 15 programmers. We were annualizing returns back then, 60%. We were very quant driven. In 2007, I decided to leave and start my own firm. And so we launched my firm, and at the end of 2008, we merged with another company called McGowan Investors. 2008 was a great year for the vol arb traders. 2007 was great. 6, all those years before the crisis, going into the crisis, were great years for the vol arb traders. Because of central bank intervention in 2009, 2010, volatility arbitrage became a dead trade. It was we were working paid to put the risk we were putting on. Annualized returns dropped drastically. Risk as measured by volatility of the daily P&Ls or even the monthly P&Ls went up drastically. So it just became a very, it wasn't a very good risk-reward bet. So, and if you recall back then, there wasn't many jobs that were being created on Wall Street. So me and my partner decided in 2011 to start our own firm. Our issue here was we had the skill set. We knew how to trade vol better than most. When I was with PFTC, we were probably the largest non-bank liquidity provider out there. So anytime a hedge fund wanted to put something up, they'd call the banks, and the banks would be calling us to take down the flow. So we had this skill set. We understood pricing. We understood how vol should move. We understood if it's not moving, why it's not moving a certain way. We understood going into events, how vol should behave, coming out of events, how vol should behave. We had this skill set, but we had a trade that wasn't working anymore. So our thought at that point was, let's take our skill set to the long-short hedge fund managers. So over the last 3 or 4 years, we've built a client base with some of the largest institutions in New York. We've built a sales team around us that basically they go out to these large institutions and they sell our skill set. And believe it or not, we can walk into a $3 billion hedge fund who out of Wharton, running a lot of money and has very successful returns over 5, even 10 years. But when it comes to trading options, trading volatility, they're completely lost. And what all these guys historically did was they would just go into the S&P/X or some index and just buy 5% of the money puts. And they just kept on losing, and half the time when the market would crack, they wouldn't make any money on the trade. So after going to these guys and realizing these things, we built this business around taking our skill set and giving it to these guys, and in hopes that it'll reduce their returns.
Bill, you're not that generous. You don't give it to them.
Well, no. I mean, we do come with a fee. There's always a cost to it, but they're very happy because the money they're spending on buying vol or making trade low risk reward bets to hedge their portfolio is very costly. So that's how we built this business, EAB, just having a skill set that wasn't working in a trade, and we just kind of morphed it into an advisory business. So that's how I got here.
Bill, what I've said to folks about you guys is that you're the best lemonade makers I've ever met in my life. When you had a trade that turned into lemons, it wasn't going to work anymore. You're like, hey, well, if the trade doesn't work anymore, let me take the other side. The problem with the other side of the trade is that nobody, right, meaning that if you're only betting a very little to make a lot, the way you guys always hedge, right? Because what I've seen Bill and his team do is that they'll go out and they'll find the most efficient, effective hedge on the board, risking as little as possible to make as much as possible if the market ends up coming down and reverses. And this is the exact opposite of what used to end up working, the way you traded, in a way I think a lot of the people in our community trade, where they would be selling those put spreads as an example, and I know you're going to go through some of this, but taking a look at what's working and what's not and why, I think is why we have so many people eager to hear about the back test. Now, the back test that I ended up asking Bill to put together was...
one thing I'd like to say before we go into the back test, Jim, is like when I was trading volatility, we were a short vol, always short vol. It was not all, 98% of the time we were short vol, and getting short vol post a crisis was just not a very good trade. So that's another element of why we why we morphed into this business.
Bill, go ahead. I ended up Bill to take a look at a bunch of iron condors. So why don't you explain, okay, how you ended up having your quants build a back test for you? Okay,
so. When looking at this back test, there's 4 things I want to point out, so there's a better understanding of what you're looking at. when I state what the name of the back test, I'm always stating in this way. It's short the upside call, long the upside call, short the downside put, long the downside put. And everything stated in percentage terms. I know a lot of people, Jim, I know you told me a lot of people in your community use deltas. Believe it or not, a lot of the equity side of the business, the bigger hedge funds, when you start to talk Greeks to them, they kind of get a little nervous. So we tend to use percentages. Well, it is Greek, exactly. But even you don't want to make the smartest guy in the room who's running the biggest money feel and look stupid. So that's one reason we use percentages, because they understand it better. And we've also found that, like, through backtesting, that is that when you use percentages rather than delta, it'll allow you to sell more vol when it's high, and it'll allow you to sell less vol when it's low. That is, if you use rather than using delta. So that's why we chose to use percentages. There's two reasons why we choose percentage rather than delta. The other one, like the duration of the back tests that we ran was either a 1 or 2 month duration. The entries were either 1 or 2 months before expiration, and the exits were either 1 month before expiration or at expiration. And the next thing I want to talk about is sizing, which to me, we've seen a lot of guys. We've seen a lot of smaller managers this has become their biggest issue. They're constantly to get the return they're looking on capital, they're oversizing these trades. And when somebody oversizes a trade and it goes against them, bad things can happen. So, for example, in our world, in the institutional world, let's for rounding purpose, let's just say the SPX is trading 2,000. So to us, 200,000 is 100 shares of SPX. So that would be a one lot in options. One lot of options equals 100 shares times 2,000 equals 200,000. So a lot of these tests we ran we were trying to illustrate what kind of size you'd have to put on in these condors to get to in the end over time end up at the same place as the SPX. And a lot of times we found it was between 10 and 15 times. So 200,000 is a one lot in the SPX. So you have to do 15 times these condors to get the same return as if you own 200,000 worth of SPX.
Hey, Bill,
does that make sense?
Yeah.
Okay.
A couple of questions. First one was about and that's why Bill put in the stuff in blue. Well, I put it in blue, but it was his words. This is institutional trader talk or floor trader talk. You know, when floor traders talked and they were doing iron condors, they wouldn't end up ever talking about, well, is that the long call or the long strike? They would always just give them 4 strikes in a row. And when you listed out the 4 strikes, they would always give them in the same order. And that was they would give the calls before the puts, and they would give the shorts before the longs. So that's what Bill was saying there, right? He ended up giving the short call and then the long call. And since he's talking about percentages, right, that was the next question that I ended up having. Since he's talking about percentages, if he says something like 5%, 6%, he's talking about selling, right, and those are the first 2 numbers. He's talking about selling the 5% above the money call and then buying the 6% above the money call. So when they're on the phone and they're dealing, okay, or on the floor, you know, there's no time for niceties. These guys are incredibly quick, incredibly efficient, and so all he's giving you is, hey, this is the way institutional traders or floor traders used to end up always talking about the numbers. So I hope that clears it up. The other question about the notional, all the notional is, okay, as Bill ended up saying, it's the underlying value of the full amount of the contracts if you got assigned on a put at the money. So therefore, on the index, like Bill just ended up saying to you, the SPX, I'm going to round it to, well, I could have rounded it to 2,000, okay, this morning. Okay, yeah. I still will, okay? Okay.
Violent rallies.
So by about 9:35, that was over, right? Okay.
Yeah.
If it's at 2,000, remember, contracts always have 100 shares. So it's just 2,000 times 100. So the notional value of the contract is 200,000. So the SPX contract is huge. And since they talk about the value of contracts across all different contracts and stuff, it's always easier to talk about in the same terms. One of the things that institutional traders talk about that I know not a lot of retailer traders do, I know it's on Obsidian, I know it's on LiveVol, but it's not on a lot of other things. They don't talk about deltas, okay, or risk-adjusted deltas or beta-weighted justice or something. They always talk about dollar deltas. They always want to know what's the dollar amount. That's why the dollar amount just means notional amount. I think that was all the questions on it. I just wanted everybody to understand that before you went on, Bill, because otherwise I don't think they'd end up getting the back test as much.
Yeah, thank you.
One question about there looked like a typo on that last slide. It says all strike price are percent away from the month.
Oh, that's supposed to be from spot price.
Yeah, that's what I thought.
Tom, you can end up updating the things over.
Yeah. Thanks, Tom. And another thing I want to point out, that the results don't even include commissions or slippage. So that's going to have an adverse effect on the returns.
Okay.
Okay.
The leverage size, okay, you want to go through the studies now?
Sure. So we'll look at, I mean, the idea of this study was to illustrate what kind of leverage you need to put on to get the same return as if you were investing the notional amount in the S&P. So let's go to the first. They're all these back tests are going to illustrate very similar things. So right now, this test is selling the 4% up and buying the 5% call spread, and selling the 6% down and buying the 7% down put spread. Does that make sense?
Yes, yes. So you end up having equal size wings, right? So the put wings are you sold the 6% below the money, you bought the 7% below the money for selling that put spread, and the same on the upside. Now, when you're selling this, your maximum risk is right, because you can only lose on one.
Yep.
Right, you can't lose on both of them. So the maximum risk is 1%, and if I understand the notional value on this is if it's 1% for one contract off of $200,000, 1%, I have $2,000 at risk on this trade minus whatever I received for the credit. Did exactly. I get that right?
Exactly.
Okay.
But to get the same returns over time as the S&P, you have to size it up. Because you can see on the first column where it says Condor, that's the actual return of just doing a same notional. If you were doing a one lot versus 200 SPX, they're the returns. If you size them up, you get the returns on the far right-hand column where it says leverage. So you have the column that says Condor, one that says spiders, and one that says leverage. The leverage is the 10 times leverage on the Condor strategy that we're discussing. So as you can see, 2007 was a good year. 2006 was an okay year. 2008 was a great year. I mean, I know it lost, but you did much better than in the market. 2009 was a good year. 2010 was a good year. 2011 was a good year, and then 2012 till today the strategy has not worked. And to be honest with you, that's exactly the 2011 was the exact year we started EAB. The writing was on the wall. The trade was not there anymore. Now if you flip to the next one, you're going to see this in almost every back test of every different condor that will be tried on a few different leverages. But the story is always the same. It worked well. It worked great late 90s. It worked great early 2000s. We don't have the data that goes back that far, but it was a trade that worked for a long time. It's a trade that's not working as well the last 3 years. And I have some opinions on why that is. But should we look at another test, Jim?
Sure. You know what? The thing is that there were a couple of questions. Would it be okay if I went over to Thinkorswim and we actually created one so people could end up seeing? I know it would end up delaying a little bit, but I think it would end up helping a lot of the people because I saw a couple of people ended up not because it's a new way of thinking. So if I just take a look at this and let's make believe that we're at 2,000 because it becomes real easy. So if I take a look at 2,000 in terms of the central price of where the SPX is, right? What I would end up doing is the following. I'll end up pulling up the options, going out. It doesn't matter which one we end up using. We could even use, February, let's say, for the 2 month. So 5%. Okay, in the one that we just looked at. If I come over to here, we're looking at the 4%, 5% call spread. So that so that means
1920, 1900.
That's the 6-7%.
Okay.
Okay. So which ones do you want to give me first? Let's go in the order that you've given me here. What if I'm looking at the 4%? Right. I'm selling. And I did right. I'm selling the 4% above the money call, and I'm buying the 5% above the money call. So what I'm going to end up doing is to kind of make it easier for folks. Instead of doing it in an iron condor, I'll end up selling the call spread, and I'll end up selling the put spread. So, right, so I have to go above the money 4%. So the way you would end up doing this is, and we can use the current price. It's no big deal, right? So I would take a look at 2061. 4% is about 82, 83. So I'd be looking at somewhere around the 20, right, the number would be 2143. So maybe I'd sell the 2145 calls, a call. And then I would end up buying something 1% above that. Right, so another 21 points above that. So I would probably be buying the 2165, and that would be my call spread in the order that I'd put it on. On the put spread, where you were selling the 6% below the money put, and then buying the 7% below the money put, again, if I take a look at the price of a 2061, and I would look at 6% below the money, 6% about 123, so I'd be looking at somewhere around the 1975 put. Right, and I'll go up to 1975, and I'd have to end up selling another 20 points below that. So the 20 up, and I'm selling, not buying. Sorry, that was me. That was a check. So, and another 20 points below that. Maybe the and I might be off. It might be about 25 points. Okay, but it would look something like this in terms of the probability that people are used to end up seeing. Okay, so that would end up being the one that we just went over. Granted, I went 2 months, okay, but this would be the way that you would normally construct it. And when you end up talking about it, if you said the 2145, 2165, 1975, 1955, people would know exactly what you were talking about because you gave me the short call and then the long call, then you gave me the short put, then the long put. I hope that clears up, right? I know my math wasn't perfect, right? You guys can end up going in. What Bill's slides are going to show you is the percentage. There was a lot of questions. Did that clear it up for a lot of folks? I just wanted to stop and go through that because this is such valuable information. I didn't want you to end up missing it going forward. Okay, guys. I'm going to give the ball back to you. I'm sorry to end up interrupting. I just didn't want. I wanted to make sure that everybody was good with that.
Yeah. No need to apologize.
Okay. And I'm coming right back to it right now.
And the point I want to make when we ran a lot of these back tests, we ran whatever we have here, 6 or 7. They all paint the same picture, no matter what the placement of it or whatnot. But they all very similar in that. Structurally, something changed in the marketplace in 2011 that made this trade not work anymore. So that's the key takeaway that I want people to understand. And we saw it back in 2011. Reason we got out of the vol space. And we can, in a few slides we could discuss. We'll come to a conclusion. We'll tell you why we think the market structure's changed. I mean, we have
So the
some
10
opinions.
times leveraged here, just for everybody, right? This is a 1-month condor. You put it on 1 month before expiration. You let it go into expiration. Every single one. You just redid it every month. Secondly, right? Secondly, the amount of money that you put at risk, and just for concept purpose, if the index was always at 2,000, you would be putting 1%, right? Because you have 1% wings. You would be putting no more than 10 times that, 20% at. 10% at risk every time because you were leveraging it 10 times.
Yeah, so it would be 10. It would be 10 condors.
Okay, great. Okay.
In that world, yes. I mean, this is done in percentage terms. It's not dollar terms. But if you were looking at 200,000, we would be doing it 10 condors.
Exactly. Okay, so I'm just, guys, David, Curtis, Al, all I'm doing is that I'm translating institutional speak to retail speak. That's all I'm doing right now. Okay. Okay. I think we got it. Okay. So we're good. Okay. So that was the first one, the 1 month condor. The next one, okay, still a 1 month condor. But when you say 2 month and then a 1 month roll, are you saying and again, retail guys tend to think in days. So that means you're putting it on with 60 days to expiration and you're taking it off with 30 days to expiration and you're doing it every single month.
Every single month.
Okay. And again, okay, here I'm taking a look. Each of the wings is 1% wide. $200,000 times 10, so exactly. I never have more than $20,000 of risk minus what I ended up receiving for it.
Mm-hmm.
Okay, and the same thing kind of happened here. I mean, this thing just totally fell apart over the last 4 years.
Yep.
Wow.
I mean, these are all going to be painting the same picture. Okay. So it's something structurally in the marketplace has changed.
Okay.
And being that
and
you
so
have
the next.
I'm sorry. Next one's for some reason this trade I'm not quite sure why it did it, but in 2012 it had a good year.
Well, one of the things that I see here that's different about it is that the call spread was only 1% wide and the put spread was 2% wide.
Sorry, Jim. I think that's a typo. It should be 8%, not 9.
Oh, it is. Okay.
Yeah.
I'll tell you what. You double check that. We'll correct it on the slides when we end up making them available to everybody.
That's fine. Okay.
Okay. So those were all the 10% ones. So you couldn't get the returns you wanted. So you ended up increasing the leverage a little bit.
Sure.
Right. Right. You went up to 15 times.
We widened it out there. I mean, you could see that we widen out the condor, if that makes sense. When I say widen out, we went further out of the
was wider, right? The body was wider, but not the wings. The wings are still the same length.
The wings are the same length, the body's wider. But to get the same returns, we had to leverage it up.
Okay. Should I go to the next one? Any comments on this? Okay.
No. Again, this was a decent year in 2012, but okay, so
now,
this was
one again, you put this on with 60 days and you took it off with 30 days, right?
Yeah, and it was a narrower body.
Okay.
But everything was all these tests were the same length in the wings.
Right. So again, the leverage. Okay, they got another question about the leverage. The leverage was that and again, he's doing the test based off of the actual leverage on it, but just to understand, if the index is at 2,000, and in a trade like this, right, we can only lose either the calls or the puts, right? We can't lose both sides. So the difference between our short call and our short put, our difference between our short and our longs, our short put to our long put, our short call to our long call, right, is 1%. So I can only lose 1% of the value of the underlying. So if the underlying is 2,000, I multiply it by 100, right, because there's always 100 shares in every contract. So it's $200,000. So the most that's at risk here is $20,000 minus the credit that I took in. So if he took in, a credit of, let's say, 1/4 of that, that means that for every contract, versus $200,000, I have 1% minus the quarter, so I have 3/4 of 1% at risk, or $15,000. So when he says 15 times leverage, his maximum loss would be 15,000 times 15. So the maximum that could be lost on this would be $225,000. Did that make sense to everybody? Exactly. The capital, okay, it's the difference of the spread minus the credit that you receive because they're iron condors. And the other important thing here is that what you're showing here, Bill, is not any specific trading strategy per se. This is just what is the yield that the market is giving us if we're just a blind iron condor seller. So it's going to tell us about how attractive the trades are and if we have any edge going in.
Exactly.
Okay.
But again, I think the message here is that the trade doesn't seem to work on almost any placement of it. Just that you could tweak it here, tweak it there. They're all going to come out to be giving you the same picture.
Right. So, and there are no adjustments. I know a lot of people in our community have all of these adjustment strategies when you get close to the edge of a short strike. Sometimes we call that the 10th because that's the part that's above money. Here, there's no adjustment. There's no anything. Okay.
Very simplified,
as I'm looking at these questions, just running everything straight through to either expiration or to the roll point, which is selling it, putting it on at 30 days, putting it on at 60 days, taking it off at 30 days.
Exactly.
And here's the next one when you end up now this one is putting on a 2-month contract and letting it run all the way into expiration.
Exactly.
And we're seeing the same type of results down here. We're getting absolutely great results early on. So why did you need all of those quants? I mean, all you got to do is put on the trades and make money. They're nice returns, but in the quant vol space, guys were getting 5 times that on real capital. So, I mean, I'm only joking. I am.
Yeah.
And here is it's interesting because here, right, when I'm looking at the difference between the two, this is 5-6%. So they're selling the 5% above the money call, selling the 7% below the money put, and then when you go a little bit wider. Right, so you're selling the 6% above the money call, an extra percent, and here you're doing a roll versus letting it run in. So wider and roll ended up having, making a lot less money in the beginning. And if you take a look at this has actually been flat for a long time. You can see, it's very, what I find most fascinating about these is, knowing how volatility really popped. Look at the drawdowns that this ended up having. And it makes a lot of sense, right? If I was stuck with selling a 2-month condor in early August of 2008, I got absolutely decimated by the time this thing was taken off.
Yep.
That would make a lot of sense to me. However, what I don't quite, I would say, oh, look at how high vol is over here by the time you end up getting in the second half. But it's interesting, even though vol was so high, given 2 months, it could actually run out of the really, the wide range that you ended up having. So the volatility does play a really, really big piece in this, both the realized volatility as well as the implied that you're selling.
Mm-hmm.
I don't see any more, specific questions about this. Bill, why did this happen? Okay, can you kind of give us the explanation on vol skews or other things that you end up seeing?
Okay, so if you bring up the next graph, it's a time series of 2-month skew.
Okay, now explain to us, what do you mean by 2-month skew?
Well, it's a constant maturity. I mean, it's kind of like what the VIX does. It's a constant 30-day, right?
Okay.
So it's looking at a constant 2-month security of the downside 25 delta put versus the upside 25 delta call. So it's looking at that ratio.
Okay.
That's the simplest way to put it. It's actually the 25 delta put minus the 25 delta call divided by the at the money.
Okay.
But
So the graph or the numbers on the right-hand side of the graph, do they have, is there basically a percentage? Does that, and I'm not sure if I'm getting this right, is that meaning that the puts are 33% more expensive than the at-the-money stuff in relationship to the calls?
Exactly. It's a ratio.
Okay.
It's a ratio. So you can see structurally, skew has changed coming out of the crisis. You know, pre-crisis you had lower skew, which is the left-hand side.
Right, if they can't read it, it starts at 2001, goes to 2014. So the crisis here in 2008, you know, here's where we really ended up hitting the crisis. And here was the low in March of 2009.
Yes. So you can see pre-crisis skew, routinely skew for many years was low.
To the left.
To the left. And now structurally the marketplace, its skew is much higher. So when you're buying your wings have become more expensive.
Okay, so if I go back, let's go take a look at the example, okay? I want to take a look and see. So what I did on the call side here, and I'm going to need a few more strikes. So what happened was that on the put side, I sold the 1975, and that had an implied volatility of 18.13. If I ended up buying the 55, the 1955, it had an implied volatility of 1888. So I'm paying a higher implied volatility. So if I understand what you're saying here for our community, when I take a look at what you're selling, what you're saying is that when that put skew has gotten much steeper, the amount of money, because we're selling a lower vol and we're buying a higher vol, it means that we're getting less money for that same amount of risk that we were putting on.
Exactly.
Okay.
So, post coming out of the crisis, the wings have gotten they've got, in my mind, they've gotten fatter. People are paying a little higher for the wings. Tail risk has got a little more expensive. Let's put it that way. And because of
now by
Condors,
tail risk, again, and I'm sorry, I just want to translate for all the institutional tools. I know you and I talk about this all the time, but tail risk means just buying those way below the money puts. So
yes.
That volatility, now when put skew gets steeper, those puts, the further you go below the money, get more expensive.
Exactly.
And we receive less money for the put credit spread that we're selling.
Exactly.
But we still have the same risk on.
You have the same risk, but you have the same risk. It's just your reward's lower. So the risk reward has gone against you, not less in your favor than it was before.
And this is exactly what was bared out in all of the backtest results that you ended up showing us how, as we got through 2011,
started changing.
We don't have the same edge that we used to.
Nope. Now, one thing I will say, we've been aware of big institutions. There used to be a time where they would be buying put spreads. Now a lot of times they're selling the vol, which is selling the higher up strikes. Say if we're looking to the downside, they're selling put spreads. So they'd be selling one put to buy three. So that's why the tail's gotten fatter, and the vol has gotten low, and the vol has been the implied vol has been lowered.
Okay.
Did I lose you there?
No. I got that completely. Okay. So what you're saying is that, because I didn't quite get, well, how would they be selling them if they want insurance on the downside? So what you're saying, if they chose the same strikes, and I know they wouldn't, if they chose the same strikes that we ended up having, they would have sold one contract of the 1975, and then they would have bought three contracts of the 1955.
Exactly.
So that if they're going to end up doing that on an institutional basis, because institutions can move markets on this stuff, we can't. So if they're doing this on an institutional basis, that would end up driving down the implied volatility closer to the money and driving up the volatility further below the money, which is increasing the put skew.
Exactly.
So the institutions have messed up our very nice iron condors that we used to sell.
Well, basically coming out of the event, the institutions or, the market as a whole has repriced the distribution of the underlying. And repricing that distribution, it was, let's say it was out of whack for a long time. And some smart guys, even in my space and even on the retail side, were taking advantage of it. The big institutions kind of put it back in line, and now the trade just is not profitable anymore.
Okay. That's the problem. Has that been the only thing? Okay, so the thing is, obviously, that we like to end up selling our iron condors and stuff when volatility is really high because we're receiving more money for them, but put skew ends up really hurting us. Is there anything else that hurts us or helps us?
There's a couple of things. The fact that volatility is low is not a good time to be putting a trade on. Now, this is a graph of SPX implied correlation, which is basically it's the market's. It's an index that measures the index vol, implied vol, versus a basket of the underlying implied vol. Now, the data is hard to come by, so I can only have 2 years of data, but you can see the implied correlation is around 0.5. I will tell you, in 2008, this implied, vol's bounded, right? So it can only go so high. So the implied correlation, when the implied correlation jumps to 100, which it got pretty close to 100 in 08, that's a great time to be selling index vol.
And doing what with the basket? Okay. Could you explain a little bit about, right? Because in arbitrage, right? Arbitrage is that you're selling one thing and buying one thing. So if we're selling the index vol on the SPX, what would they be buying?
They'd be buying a basket of stocks. Like, we were vol arb traders. And in the vol arb space, the idea was to buy cheap single name vol in hopes that there's some event or some earnings comes out or the stock makes a big move, and to hedge it, you would be selling index vol. Now, that was a very profitable trade for a long time. That trade has not been around for, like I said, 2010, 2011. It just, when vol spikes, implied correlation spikes, index vol is a great way it's a great entry point when the implied correlation gets up to about 70%. I mean, you could see, the retail space can see this because the SIBO actually puts out an index on it. It's called the JCJ. It's an implied correlation index. And it measures the top 50 SPX names, the implied correlation versus the SPX implied vol. So, but as you can see, it's selling vol over the last, selling vol in a market that just grinds higher it's a losing trade.
Okay. The SIBO, if I can just for folks, the SIBO actually puts out two indexes because the way they calculate the index using January options, there's overlap. So there's actually two indexes. There's the ICJ, right, and the JCJ. And one is used 1 year and one is used another year. That's why if you take a look on my chart right here, you take a look at how much data is here from 2010 to 2011. So obviously if I wanted to end up looking at this period of time, I'd have to end up using the ICJ. Right now, this is the CJC. And over here, this only goes up to 2013. There's no 2014 data in here. So I can take a look back, and if we take a look at what we look like in early 2011, we were up in the 80% range.
Great vol, great vol, yeah.
When I hit enter and I come to the JCJ, I don't know if I'm getting the date. Oh, you know what? That was the JCJ. If I have to go to the ICJ, hang on. You know what? Thinkorswim is giving me some issues. Okay. Now, I'm not up at 80 anymore like I was back in 2011. I'm at 56. I'm at an incredibly low. Now, when is this going to end up helping me to sell my iron condors, and when is it going to hurt me? Was it me who lost everybody, or did we lose Bill?
No, I'm sorry.
Okay.
I accidentally hit the mute button. Basically it's an added tool. When vol's up, implied correlation is going to be higher. It's going to be a better time to be putting these kind of iron condors on.
Okay. Okay. So if I come back over to here, here's your chart of it, and you actually have done the calculation throughout, so I don't have to flip back and forth from year to year to end up being able to see it.
Exactly. That's the calculation we have in our internal systems. We calculate it. We can,
Now, this is only calculated with end-of-day pricing, right? So there's only one value per day. So it's not something you'd ever look at intraday. It's just more of a trending thing.
No, it's end of day. Yeah.
Okay.
You're not going to.
At least that's the way the SIBO reports it.
Exactly. It's not an intraday kind of tool.
Okay. Anything else, or should we go to conclusions?
We can go to conclusions. So I guess the conclusions I want everybody, people to take away from is that the trade, the iron condor trade is a less favorable risk reward trade when low implied volatilities, which we've seen over the last few years, steeper skew, and low implied correlation. It's a more favorable.
Which is what we have right now, pretty much.
Pretty much. We've had spikes. We've had spikes. I mean, even in the last, I will say, as we trading, we implement hedging, but we're very price sensitive. So we're rarely buyers of front month vol, we'll say. But we'll say a month ago, because of seasonality issues, vol got so cheap that we were buying December vol because we knew it would hold and actually rise into the Fed event. And then yesterday morning and Tuesday afternoon, we were big-time sellers of vol going into the event. So there's still times when selling vol is good. Post that, coming out of some event that they pricing vol real high.
I think everybody, what you just said, found that, I know I did, found incredibly fascinating. How did you determine going into December that volatility was cheap? So what you're telling me, in the beginning of December, I should not have been putting on my wide iron condors, which kind of, I scratch my head because I go back and I think usually December is the greatest time to be selling iron condors. Why wasn't it this year?
Well, historically, we're a seller of December Jan vol as a vol guy. It's seasonality issues. It's slow. Nothing's really happening. So it's always been. But a lot of institutions have caught on to that. I mean, we've been doing that trade for years and years and years. I don't know if it's just people are more educated now on seasonality within the vol space, but we just knew that we had a Fed event that we thought would be impactful. And it just got so cheap. And we forecast volatility. That's one thing we do internally. So even against our forecast, it was cheap. And that rarely happens. And we rarely ever want to buy front month gamma. But the market was giving us an opportunity in December to buy it. And that's exactly what we did. And then 2 days ago before the event, we kind of got a little lucky with oil selling off, but we were able to sell. We were sellers of vol for the last 2 days, and we eventually just got. We were seeing SPX index vol, IWM vol, 50% over our forecasts. So when things get that high, we're big time sellers.
Wow.
So my point is, in recent history, yes, implied vol has been low, and we've been buyers, but. Late October, you're sellers. You're still getting some spikes. It's never sustained. And hence, the more favorable risk reward is, which we saw, coming into the week. We had high volatility levels, and skew was more flattish because we had to sell off. Mm-hmm. And correlation did spike a little, but it was an okay indicator. So
I think that, I'm sorry.
Some of these reasons why vol and skew has kind of moved the way it is you know, the marketplace doesn't. It's hard to fight the Fed, right? So everybody feels very protected that, you know, you're going to get these real shallow. You know, what I've noticed is you're getting these real orderly and shallow sell-offs, and you're getting these violent spike rallies, these violent rallies, and that's just a lot of that has happening because of the central bank intervention. I mean, our greatest fear in October, we were hedging. The market was going down, and our greatest fear was central bank intervention, and it's exactly what happened. China stepped in, Japan stepped in, Europe stepped in. So it's, you know, it's.
Can you give us an example, like you say, when you sell vol, some of the people are asking, like, what was the trade that you did in early December when you were buying vol, and then over the last couple of days when you were selling vol, what were some of the trades that you'd end up putting on to be able to?
Okay, so we need to hedge. So at this point, we're just trying to hedge books. We're trying to we're the short side of a lot of people.
Right. So by hedging books, what you're talking about, you're hedging somebody else's portfolio. So you need to make a crap load of money if the market goes down, and if the market goes up, you just shouldn't lose that much.
Exactly. So what we did was we had an opportunity to buy cheap December vol. So for example, we were using the IWM. We were buying the Deck 115 puts.
Let me pull that up so everybody can see that. Okay. So let me come over to here. I'm sorry. I should have been ready for you. IWM. By the way, if anybody knows how to end up doing this with Thinkorswim, sometimes it happens where you just can't end up using it. Okay. So you were buying. Okay. And now, granted, it's a while now, so we can see where the prices were. You were buying 115 puts.
Yeah.
A while ago on this.
Yes.
Okay. Now let's take a look and see where those 115 puts were, because I just have to come over the chart.
Now, I want to. This is the important piece here. We're hedging a book, so this is not supposed to be profitable trade. It's supposed to be the least non-profitable trade. Like that, our whole business is being price sensitive to vol, and trying to lose the least on a hedge.
If the market rips up. If the market rips up, you're supposed to lose the least. So you were buying 115 puts. Now, 115 is right here. So when we were ripping down and volatility was spiking, those things just went through the roof. They made a ton of money for you.
Yeah, but what we did was, now vol, at that point, vol spiked, right?
Yep. So what I'm going to end up doing is, for everybody, give me 1 second, because I'm going to pull up the VIX on the Russell. For those of you who don't know it, that's the RVX. And let me come over here. And what I'm going to do is I'm just going to end up doing this for the last 3 months so that it stays up this way. So, yeah, we can see it really, really spiked. I mean, the RVX went from the low 20s up to about 26. Now, it's interesting. That didn't seem to spike as much as the VIX did. And I take a look at the VIX. Yeah, the VIX had a much bigger spike, right? The VIX went up almost 100. We went from 12 to 26.
We had the same trade. We had the same trade in the SPX. Basically, we were long at the 2020 put, December.
Okay, so if I come back over to here and I take a look at the options, the 2020 put on the SPX. Oh wow, we got way down. I mean, so you were like $70 in the money at one point with high vol.
But now, how we monetize this trade somewhat. I mean, remember, we just ripped. I think we're up on the month now. So we were selling Jan vol against the deck at that point. So vol got a lift in January. Now we have seasonality issues. So now so against that deck long put, we were selling the Jan further down.
Okay. So now what you and if I'm just trying to end up making sure that we all get this. So vol was elevated, and when I take a look at vol, one of the things that I end up having is that I could see that when volatility is higher, you're selling more time because you get to you get a lot more money for selling the vol when you have more time. So you were actually selling the time with the higher vol to collect a lot more money. Okay, let's just take a look and see what that ends up meaning on the on the analyze page. So if I take a look, I'm going to open up these, and just for at the money, okay, I'm looking at this and I'm taking a look at, okay, so you're selling about, right now the at the money is about 11, but if I go out to February, the at the money is almost at 15. So right, that's term structure. So you were actually getting a much higher vol, okay, that you were selling against what you were long.
Well, we were selling further down because we weren't selling like the same strike. We were selling further down Jan, so we got because of the skew, we were selling higher vol, and because of term structure, we were selling high vol. And at that point, vol was high. We were trying to take advantage of seasonality in Jan.
Wow. Okay. So you were almost like double dipping on this one. You got higher vol because you sold longer term, and you got even higher vol than that because you sold further below the money.
Exactly. No,
that makes a lot of sense.
I will. Most times of the year, that trade's flipped. Most months of the year for clients, we're flipping that trade, where we're selling the front month and buying the second month, because vol's low enough to own it, and so. But
because you carry so much more Vega in that back month, so that if vol does pop, you guys make a lot of money on Vega.
The Vega, but because vol is where it is, we can't. And our hope is, in over the next 2 weeks, this is going to set up back to a more normal way, and we'll start hedging where we're buying second month, selling front month.
Now, did you close? We got to ask. Okay, they want to know. Did you close any of the Ds that you were long, or did you just sell Jans against them?
Well, what we did was, at this point, we own December 31st. We closed them. We were selling all our Jan vol the last 2 days against the December. December ripped up. We closed all our Decembers today. And now again we're hedging. So our normal trade's not setting up. So we just went into a straight put spread in January.
And but you still have a vol advantage in a put spread, because if I take a look at a put spread and give me which strikes you might have looked at.
The SPX, the 200.
Okay, which is the 2,000. I know you're speaking SPY.
And the 1900.
And the 19. I need more strikes.
2,000, 1900. Sorry.
Yeah, that's okay. I can add zeros. Okay, so I'm looking at the 2,000. So you were paying about right now, and I know that it was a little bit different, but you were paying you were buying a 1522, okay, vol, and you were selling a 23. I mean, you had 8 points of difference in vol.
Mm-hmm. That's why the trade, but the thing is, a lot of clients want catastrophic risk coverage, catastrophic hedging. This is not providing that. But when it gets too cost prohibitive to give that kind of trade, you have to assume some risk. So we're moving into put spreads because we feel this is the best risk reward at this point.
I could see. I mean, when you have now, that's a very steep put skew. When you have 8 from 15 to 22. I'm sorry, 15 to 23. That, to me, I mean, is it normally that steep?
No, it's been high, but it's probably moved today because the market's rallied. Skew will steepen as the market rally and will flatten as the market goes lower.
Okay.
So after this 2-day rally, skew will steepen.
Okay. I don't know if you can end up answering this question if you're at liberty to, but one of the things is that some people are asking that you forecast vol. Now, when you forecast vol, you're not only looking at IV levels, but you're looking at it in terms of also forecasting the skew and also how it'll change from month to month. Are you allowed to share how you guys do your forecast? It's okay to say no if you can't.
We don't forecast skew. That's like a whole different animal. Trying to forecast the probability distribution is a whole different thing. But okay. It's basically forecasting. It's very Garch-like. We look at different terms. We weight different terms, different realized vol terms. It's anchored to a 2-year vol. So
Okay.
it's always being pulled up or down towards a 2-year vol, and it's weighted. It's much more front weighted because we are front. We like to trade the front 2 months. So
Right.
we're going to
Well,
wait.
they move much quicker too.
Yeah. Right. And plus it's easier to forecast. It's easier to forecast vol.
Yeah.
You can't. It's hard to forecast a 1-year vol. I mean, who knows?
Mhm.
So, you can forecast tomorrow's weather, but it's hard to forecast the years out weather, that kind of thing.
Yeah. Yeah. There's just too much. Right. We've seen that happen through 2008 and 2009. It's you take a look at where vol's going to end up being in a year, and it's like, oh my God, it's not even close.
Yeah. So.
Okay. I think that was most of the questions. Tom, I had been reading them. Did you see anything else?
No, I think you got them.
Okay. And what I'm thinking here, Bill, do you want me to end up bringing up the tear sheet? Because I know that you've been doing it, because I know you've been helping me do this one.
Yeah.
I'm sorry.
One of the takeaways also is, and why we built our business was, hedging has become cheaper because it seems like everybody wants to sell vol. We had a conversation with a guy that just went over to one of the biggest asset managers in the world to run their vol book, and this guy's been a long vol trader his entire life. How anybody's a long vol trader and survives is beyond me. But one of the largest asset managers, all they want to do is sell vol. So a lot of these institutions that used to be buying vol are selling it now. And that's just giving guys opportunity to jump on the other side of the trade. Now, to me, that's saying we can hedge books cheaper. So that's how our business has started and how it's evolved, and we're actually evolving our business into asset management, and we're actually building product where we can buy the index and we can hedge it cheaper and try to capture, say, 70, 80% of the upside, while still, in big moves down, we're 50% of the downside, let's say. So we've kind of taken these kind of ideas that we've developed over our careers, and knowing that pricing sets up a certain way, we think there's an appetite for like a product like hedge equity, where you're just buying the index and you're using our skills to hedge it in high vol environments and low vol environments. So
I just pulled up, all of the back testing and the stuff that you've traded alive for the last year.
Mm-hmm.
And while I take a look at here the hedge SPY, over a period of time going back to January of 2007, one of the things that as a retail guy, sometimes I'm saying, well, why should I end up going into your product? You're only at 69.6, and you haven't even beaten the S&P over this period of time.
Well, if you look at the risk, it's a different picture.
See, now this to me, this to me is, now you're starting to, this is the difference between retail and institutional, probably one of the biggest things. No institutional guy ever looks at returns blindly. Okay.
Yes.
What they end up looking at is that the volatility. Now, all the volatility is This is the actual. This is the VIX, if you will, that they actually did realize. So instead of trading but remember what volatility is, right? It's a one standard deviation chance that it's going to move 16% up or 16% down. During this time, there were lots of times, 2 out of every 3 years, we're going to move at least 16% up or down.
Exactly.
Okay, in the SPY. You reduced that
in
risk
1 year.
In 1 year. You reduced that risk by over a third.
Exactly. Now, yeah,
and
a lot of that comes out of 2008 being hedged in 2008, but the idea is to try to kind of get close to the returns while reducing the risk. A rational investor would be more than willing to accept 40 volatility if he's getting 80% returns.
Right.
A rational investor would be willing to accept 50 volatility if they're getting 100% returns. Now, the S&P historically, I think over a much longer data set has a Sharpe ratio of close to like 0.8. But over, I think over the last year and a half, it's run at a 2.
Right.
So we're just trying to match the market over time. That's the idea.
Match the market, but do it with a lot less volatility.
A lot less volatility.
Very interesting. Really, because to me, that's what it really comes down to, right? It's a lot of times we look at, as options guys, we'll look at how do we end up making a lot of money in a very short period of time. And I think that not focused on risk and size of trades are probably the two biggest downfalls. And it seems that, your entire business, it revolves around those points.
Sizing is everything, and risk is everything. I mean, if you got to look at the risk relative to the return, because if you're not doing that, if you're getting 25% return a year, but you got a 75 volatility to get to it, and eventually you're going to get yourself in trouble. And a lot of that comes down to sizing. An irrational investor would accept 25% annualized returns with a 50 annualized volatility.
It's just a matter of time before you go out of business, though, with something like that.
It is. No institution would ever invest in a product like that. I mean, your reward has got to be greater than your risk. So when you're putting with these iron condors, you should be looking at the risk you're putting on, not just the return, because that'll be dangerous. And a lot of times people are just looking at a return and trying to size up these trades to get return on their capital. And a lot of times they're not in their favor.
Right. We're going a little bit more than about it.
At least in the last 3 years. What's that?
I was going to say, are there any last questions here from because I'm looking to see if there's any last questions, because we've been going a little bit more than an hour. Tom, I think I got most of them. Do you see any that I might have missed?
Yeah, there was a last one from Robert. He wanted to know what the right-hand side of the backtest table labeled volatility was.
Okay, no problem. Let me go back to that so you can end up seeing that, Bill.
It was the annualized volatility of each strategy per year. There was volatility. They're not labeled. In the box it says volatility. The first one's the volatility.
Same as they are on the left, right?
Exactly. It's the volatility of the condor. It's the volatility of the spiders, annualized volatility, and the volatility of the leveraged.
Okay, so you're always looking. You never look at returns in a vacuum. You always look at returns versus risk.
Exactly.
Okay, so I can end up seeing, that in a trade like this, while I might have been happy, with some of these returns, like let's say, well, no, I wasn't happy. I mean, I'm looking at like 2013.
It was a very good year for the market. Not a very good year for vol traders.
Right. I'm looking at that. Not only did you lose money, but you did it and had more risk. Okay. Ow. Okay.
Yeah.
One last question. How would retail traders measure skew on a daily basis in SPX?
Jim?
The way you can do it one of two ways. What I end up doing is that I will look at live vol. They have a better graph, but you still have to end up doing it by hand. I don't know of a tool that will end up showing you what the skew of the options look like on a 25 delta. I know that Bill has these institutional tools, and whenever I end up asking him, Bill ends up sending me charts like this from, is it Vol Edge and Risk Edge, or?
Yeah.
Right. So they're institutional, not just skewed tools, but I know that you've shown me multiple time frames, term structure, all kinds of things. It's kind of like
Yeah. It's a vast database of all different, every optional name out there with all different types of vol measurements. It's a very high-end system, but the vol edge is more like it is kind of more like a retail space. It's just I'm not sure what it costs, to be honest with you. But you know, I don't think you're going to get like Thinkorswim doing these kind of vol calculations for you.
No. Plus, you're also normalizing them to 60 days. I mean, you're doing a lot of heavy-duty lifting in some of these tools.
Yeah, exactly.
Yeah. One of the biggest things that we've seen end up happening with folks is that, you know, sometimes people end up seeing that their trades work, and all of a sudden stop, and they don't end up working anymore. Bill, I'd love for you to come back. What we'll end up doing is that I asked Bill just to take a look at a couple of basic condors, for basic iron condors for us. If there are areas, please send Tom and I emails, and we can have, maybe you come back once a quarter if that wouldn't be too much of a burden. Just kind of give us an update on what's working, what's not, what you end up seeing going into the market. I mean, how many of us, and I know I was one of them, would have loved to known that vol was really cheap, okay, at the end of November, beginning of December, because selling those iron condors in December is a trade that has worked every single year for the last 15 years. Okay? Yep. So, Bill, thank you very, very much for sharing your time. It's been very, very informative, and on behalf of the whole community, we really, really thank you.
Yeah, I appreciate you guys having me on, man. I enjoyed my time.
Yeah, thanks very much, Bill.
Okay, thanks, Tom.
Good night.
See you, Jim. Have a good night.
Right.